Now we are about to begin a session on navigating climate finance in Global South. And this will bring together our distinguished voices to explore and deliberate on innovative financing instruments, the pathways to eliminate financial barriers for developing and vulnerable economies. And through this engaging dialogue, we aim to uncover how capital, policy, and innovation accelerate a great energy transition across the Global South. Well, now I take this opportunity to welcome our esteemed panelist, Mr. Rajiv Ranjan Mishra, Managing Director, Aprava Energy, Mr. Kaushik Chatterjee, Executive Director and Chief Financial Officer, Tata Steels, Mr. Helge Muel, Chief Sustainability Officer, DBS Bank, Mr. Asitava Sen, Co-founder and Chief Executive Officer, Carbon Removal India Alliance, and Ms. Madeline Schneider, Director of Operations, Partnership for Carbon Accounting and Financials, to the dais. Once again, I request all the members standing to please settle down. We are just about to start the session now. So please take your seats and be seated, please. Once again, I kindly request all our members to please settle down so that we can start off the sessions now.
Should I just start? Or shout at them to sit down?
Maybe.
Stop talking.
So once again, I kindly request all of our members to please settle down so that we can start over the sessions now. Thank you. Now I request our session chair and moderator, Mr. Rajiv Ranjan Mishra, the Managing Director of Aprava Energy, to kindly share this timely discussion. Now, over to you, sir.
Why don't I start there? Thank you very much, and thanks for everyone for sitting down and stopping to speak. Welcome to everyone on this panel. The panel is titled Navigating Global Finance, Climate Finance for the Global South. But before that, a very quick introduction for myself and the panelists here. My name is Rajiv Ranjan Mishra. I'm the Managing Director of a power company called Aprava Energy, based in India. On the panel, we have Madeline, who heads PCAF, Partnership for Climate Accounting Financials. They will all introduce the work that they do when we come to the panel, of course. Mr. Kaushik Chatterjee, who is the Executive Director and Chief Financial Officer of a little-known company called Tata Steel. I've also asked him to introduce his company since none of us know anything about it. Helge Muel is the Chief Sustainability Officer of DBS Bank, which is Southeast Asia's largest bank, #1 in Singapore, of course, and quite a large presence here in India as well. So a lot of us, you would have seen them and interacted with them. And finally, Mr. Asitava Sen, who is the co-founder and CEO of an Alliance for Carbon Removal in India, CREA, and he will present his perspective as well. Just a little bit of introduction on the topic. Whenever we are talking about transition finance for the Global South, it appears like an ocean. But if we can sort of focus it a little bit, come down a little bit and look at it, one of the things is obvious. The climate finance is crucial for bringing about the renewable energy transition that the world desperately needs. That's fact number one. Fact number two is that the most vulnerable economies are the emerging economies, the non-developed world. And they are the ones who receive a woefully short amount of the capital that is available. There are estimates that vary. Ex-China, excluding China, the developing economies are forecast to need about $2 to $2.5 trillion a year to meet their 2030 targets. In India itself, I think we have seen numbers of net zero by 2070 requiring about $10 trillion. No matter which group of countries we look at and the number of finance we look at, one thing remains constant, which is the amount of actual flows are insufficient to reach the target. In the case of India, and having worked representing industry from here in particular, two other things stand out, and I'm speaking more from a renewable energy industry perspective. One is the high cost of capital. If you look at a renewable energy project in Europe or America, they will raise debt at 3 to 4%. Over here in India, we have to pay 8 to 11%. It's not a difference in technology, it's purely a difference in financing cost. That can have a tremendous impact on the economics and indeed the affordability of the entire thing, because, some estimates are a 1% change in interest rate affects almost 5% of power costs in India. Or put another way, the emerging markets, 1% reduction can save approximately $150 billion a year. So it's not merely a number, but that's something that affects the facts on the ground. The second thing, and it might be a little controversial, is the credit rating, the sovereign rating of the developing world. Only 12 out of 130 countries are at BBB minus or above. India actually had a credit rating upgrade to BBB for the first time in 20 years, with never ever in its independent history having any record of any lender having to take a haircut anytime not paying its bills for all its troubles that the country has gone through. The reason for that is very, very similar. By the way, BBB is also now the credit rating of Greece. And this is not to be disrespectful towards our European colleague, but it is just to highlight that it has had a lot of some difficulties, let's say. Mercifully, they are behind them. That is behind them, but they have had a lot of difficulties, and yet, after 80 years, that is where India's credit rating stands. Those things really affect the cost of capital and make transition difficult, even in a country like India. So, and why does that happen? By the way, there is, as I understand it, a particularly high weightage given to per capita GDP in these credit rating calculations, where obviously the populous countries of the South do not stand up. And therefore, we have the situation where, irrespective of how a sovereign may have behaved, and its corporates, for over half a century, the credit rating remains that at a level which increases our cost of capital. So those are some of the thoughts that I had. I did say that we have an excellent panel. We have a corporate, a bank, a financing institution, a carbon financing expert, as well as a non-corporate looking at removal of carbon dioxide and the financing related to those. So those are the topics I'd like to explore. So with everyone's permission, can I start with you, Mr. Chatterjee? Everyone knows Tata Steel. One thing we do know is, quite like my industry, power, steel takes billions of dollars in years. Steel mills take billions of dollars in years to make, to come to the market. How do you, does your company manage this challenge of, meeting your short-term business goals? Short-term might well be even 10 years in your case, whilst being ready for the world that is coming, where the customers would expect green steel or steel made from technologies which are much less carbon intensive. Perhaps you can start there, and I'll take a seat over there as well. Please feel free, any panelists, to speak either from your seat or from here. Thank you.
Thank you. Good afternoon to everyone. Just to expand on Rajiv's question, if you look at the decarbonization as a theme, it's slightly different from greening. Greening is, in a way, ab initio start of build. Decarbonization is you have an incumbent configuration which emits carbon and you want to reduce to a low carbon configuration. So subtle, but there is a difference. And the reason why I wanted to talk about it is there are many funding agencies, sovereign and at the private sector level, or multilateral agencies which are more focused on green financing. Transition financing is actually a bit of a messy financing because transition financing also includes restructuring. It also includes phasing out of what you have as your incumbent asset base. My current experience in Europe, where the pace of the transition financing is very high, and I spend a lot of time with the Dutch government and in the UK with the UK government. There are fundamentally three things any corporate would look at, as any shareholder would allow a corporate to look at, is you need to have an investment case to start with. If you have an investment case, then you can have private sector banks or IFC Washington or whoever else wants to come in, and they will look at what is the security of the money that they would lend on the other side of the transition. So the investment case becomes most important. And when you look at an investment case, a decarbonization investment case is more challenging than a green investment case. The reason is in decarbonization, you're changing some element of the supply chain or the value chain, which is reducing it from high carbon to a low carbon setup. And that necessarily doesn't add to a product mix which is different or a customer profile unless the customer is willing to pay. So the investment case is actually stands on three legs: what a company can do, what the customer will pay, and what the government can support with. Government support typically comes in EU context is almost like a viability gap funding. So the company will provide an equity, its own cash generations. The customer has to pay for the green steel. If they don't pay for the green product, it doesn't make any sense to do decarbonization. And then, of course, the government through the, in Europe in particular, the EC allows some amount of funding, excluding it from the state aid framework, which essentially then builds into a case which can get funded. On that, then the funding available for the lenders becomes much easier, because the lender comes in to see that there is a commitment from the company, a commitment from the suppliers, and there is a commitment from the government. On top, it is more like a icing on the cake, so to speak, but the stakes are high for the three big stakeholders. So that is essentially on which transition finance works. Now, if I just go and say that I need my lender to take all the risks and I will take a small part of the risk, it's unlikely to work. And therefore, any amount of structuring that we may do on the financing side, these are the foundations on which it builds up. After that, if there is a tenure or a step up of the economics of the funding, etc., it is different. So when we look at from an Indian context, again, the first element of the investment case actually comes in when you actually price carbon. If you don't price carbon, decarbonization is a vanity value. There is no economics behind it. When carbon gets priced, as we know in anything in our lives, if there is a cost to anything, then we are more alert to making the transition. So when carbon gets priced, and hopefully with the CCTS coming in, and if a market-based pricing comes in rather than a nominated-based pricing, that's the best way where CCTS can succeed, like EU ETS has succeeded over 15, 17 years. It will become useful. The companies or the organizations will get the trigger that if I don't reduce carbon, even if it is a hard to abate, like in my sector, it will hurt us in terms of cost outflows on account of the carbon pricing. So then the start of the decarbonization happens, because there is a clear investment case, because the counterfactual is going to be a lot more costlier. If I don't decarbonize, I will have a cost which will affect the value of the firm. And that is when it starts to work. And then I don't expect the Indian government to play the role that EC has done, because we are a capital importing country anyways. But if there is, for example, structured obligations or sovereign guarantees given on certain projects which are large, etc., across sectors, there could be a way in which the transition can be made more efficient.
So I have a, first and foremost, thanks very much. Excellent point about pricing carbon, without which obviously this does not become economic. But just want to follow up on your experience in the UK. I'm aware of the news item about the Port Talbot, your replacement from the old blast furnaces to the, with as per news articles, 500 million pounds check being written by His Majesty's Treasury. Now, those markets already have a compliance carbon market, and yet the sovereign had to write a check. What does that do to the developing economies where the governments may not be able to afford? What does it do to the path of transition? If you had a similar situation, say in India or, I don't know, Nigeria or Indonesia, how would that work out? Is there no hope for them then?
So the reason why the government came up, irrespective of the carbon market, relates to the same concept of just transition. Because if the cost is going to be so significant and it doesn't meet the investment case criteria, in a peculiar case in the UK, not so much in any other, UK as in our plant in the UK, which had come to end of life, we had no incentive to invest in a similar facility which will have to pay the same level of carbon, which will certainly not make an investment case. And in that case, it would move towards a closure, which then affects the employment, the society, livelihoods, which is the reason why I said just transition. So it was a combination of two things. It was about, post the Ukraine war, it's become very clear that every country needs foundational sectors like steel. Second is, if the investment is not going to be made, it will result in a closure, which will affect the livelihood. And third, therefore, not just directly but indirectly, because the entire supply chain get affected. We've been the only steel company in the UK. So it's a combination. To your question whether what happens in India or any other geographies for which the governments cannot provide it, it's certainly going to be a tough choice. And if it comes to that level, where the issue is, again, from a policy level, if that particular sector, be it steel or aluminium or whatever it is an important part of the foundational economy, either you can do it through policy or you can give a check. It can also happen through policy. I mean, we have had investment allowance in income tax for a long period of time. So there are multiple ways you can do it. The PLI is in some ways a similar stuff. Yeah. You have to possibly have a mega PLI you can't do it with 200 crores limits. So you have to do a mega PLI for prioritized industry, like you see in defense today in India. So I think it's a combination of a policy. You don't need to necessarily have the checks to be given, but the policy can enable. Setup times can be faster. You can ensure that the infrastructure which is outside the plant is more efficient. So the entire ecosystem becomes more greener. You have a renewable power network which ensures that you have the ability to reduce your scope 2 emissions. And finally, what we produce, there is to be a value for that low carbon product with the customer. Honestly, it starts with there, because if the customer is not willing to pay for a green product or a low carbon product, nothing will stack up eventually for the big investments that we do, because any company produces for its customers.
Thanks. Why don't I move to Madeline now, just intersperse corporates and institutions. So Madeline, you had a PCAF, of course, which is a Partnership for Climate Accounting Financials. And so this is a simplistic question, a dumb question perhaps. I work for a mere power company, and when we go out for financing, International Bank would say, just follow the World Bank standards. Sometimes, there is a whole alphabet soup of CFD, GFANs, SBTIs, World Bank. How do we make sense of this whole alphabet soup? Where does PCAF actually stand? How does an investor, or for that matter, I know you are focused more on financial institutions, but perhaps for this audience, as much as for the dumb moderator, you could start by telling us exactly what you do and where you fit into the entire chain.
Yeah, thanks so much, and good afternoon also from my side. A great pleasure of being here, and also thanks to CII for hosting this powerful event. Maybe briefly for the background, to set the context for your question, if we think about the key steps that are necessary to move towards decarbonization and to accelerate climate finance, actually measuring of the emissions is the key first step. So that's the prerequisite for financial institutions to understand the status quo, so to assess where are they actually with their emissions, to then be able to take the next steps, so to meet disclosure requirements, to identify the highest emitters in their portfolio, to set climate targets, and then also to design financial products that support the decarbonization. And that's exactly where PCAF comes in. So at the beginning with the measurement of the emissions as a first step to decarbonize. So as you said, PCAF, abbreviation can be tricky. So it's the Partnership for Carbon Accounting Financials. And that's actually a global initiative of financial institutions that work jointly together to standardize the measurement of emissions and also the disclosure of emissions associated with financial activities. So also important to mention that it's actually an industry-driven initiative, so from financial institutions for financial institutions, with the key objective to harmonize the approach to calculate and disclose emissions. And actually a key milestone was the launch of the PCAF standard in 2019, which is built on the Greenhouse Gas Protocol and extends the methodology for Scope 3 Category 15 emissions, as the GHG protocol sets the framework and PCAF expands for the financial industry, because there was not such a methodology at that time. And yeah, maybe also important to raise that in 2019, in the same year, PCAF also became global, and since then actually, received a very strong increase worldwide. So we have currently more than 630 financial institutions that are part of PCAF, and that includes all types of financial institutions, so asset owners, asset managers, commercial banks, development banks, and insurance companies. And all of them commit to measure and disclose their emissions in line with the PCAF standard. So, because you also asked, the PCAF standard is publicly available. That's a publicly available source. And then in addition, for those financial institutions that commit to PCAF, they also receive services and tools, technical assistance, emission factors to facilitate their calculations. So that's how we support them. And maybe also, of course, here specifically interesting for the Asia-Pacific context, it's the fastest growing region that we have. In PCAF, we have more than 150 financial institutions that are part of the Asia-Pacific region, and especially since last year, we see very strong interest from and momentum from Indian financial institutions when RBI launched the draft disclosure framework on climate-related financial risks. So that's why we're also very excited actually to be launching the PCAF India chapter, a dedicated India chapter this week in Mumbai with our signatories to even further in more detail support Indian financial institutions in GHG accounting. And we actually also have the PCAF India team today also in the audience, also the board member Prashna Khanna. So feel free to reach out to us also afterwards in more detail. But maybe to conclude on your question also, so as I highlighted, measurement of emissions is the first key step in the decarbonization. And then afterwards, we, so to say, hand over to the other alliances. So we are closely aligned with CDP for disclosure. The measurements can be directly used for stakeholder transparency. Then we hand over to SBTi for target setting. Also here, PCAF is directly aligned. Same also for CII-ITC, for instance, for transition finance. So we are focused on the first key step, measurement of emissions, and then really aim for harmonization across all key steps of the decarbonization.
Thank you. Thanks very much. So this week we'll see you, Indian institutions join the alliance as well.
Yes, actually we already have 12 signatories, which we are very excited about to be starting the India chapter together with them, including 3 of the largest Indian financial institutions, and also 4 accredited partners. So these are service providers that support financial institutions in GHG accounting and undergo PCAF accreditation, so to ensure that there is also high level of quality ensured when supporting financial institutions. And of course, now with the India chapter, we will then further, together with the signatories that we already have, who are also, we are having chairs and vice chairs, so it's again driven from the institutions themselves. We are mainly facilitating it, of course, then also focusing on further growth and aiming to, of course, grow the community also here in India, so that PCAF becomes also here the standardized framework.
Thanks. Helge, moving on to you. DBS has had a strong presence in India as well, and of course, you're very big in the region. I thought perhaps you could start by telling us, what are the recent trends that you have seen and any recent in the whole sustainability agenda affecting our part of the world, and any particularly innovative product that you have seen which has been more successful than others in unlocking finance for the Global South, to go with the theme of this conference?
Absolutely.
Very simple question, 2 minutes.
Absolutely, yeah. 1.5. So thank you so much for having me. Really great to be back. I always loved being back in India. Firstly, I got to know my wife here, stargazing north of Pondicherry, and secondly, I always love the energy, so that's really fantastic. So I work for DBS, Singapore headquartered bank, fairly large here in India. We have more than 350 operations. I think we have the largest branch network actually in India of any foreign bank. So let me start with a positive statistic maybe, to get a bit of positivity back. About 10 years ago, for every dollar the world spent on fossil fuels, we spent around 85 cents on clean technologies, can be renewables or other sorts of technologies. Last year, for every dollar that we spent on fossil fuels, we spent $2 on clean technologies, and the trend will continue. And there's a whole raft of other fantastic measures. I love the Minister of Trade and Commerce this morning, for example, mentioning many, many things that are happening in India. More than 50% of power capacity will come from renewables this year, and so on and so forth. And I stress this positive statistic to start before I answer your actual question, because sustainability professionals are extremely skillful, focusing on all the things we fail to do. And I want us to be also a bit conscious about all the great progress we're actually making. I'm sometimes really puzzled. So it took us hundreds of years to build the societies we live in today, and now we're getting nervous because we don't rewire them by 2030. What the heck? This will take a little bit of time, and we're actually making real progress. Now, on the recent trends, I'm not saying this because I'm superficial. I'm very conscious about the challenges we face. Some of them are daunting. Some of them are structural in nature, they're global in nature. Others are because there are people in the White House that want to do things differently. Whatever it is, there's a whole raft of challenges. I'm very, very conscious about that. But I think here in Asia, and we operate really all across Asia, I see a lot of constructiveness and positivity from policymakers, regulators, the private sector, all across. And I think one of the reasons for that is that we have always defined sustainability in a broader way. It was never going to be just about climate action. Climate action is one of many challenges we face. we have to first and foremost improve people's lives. It's really all about improving people's lives, those people that live today and those that are going to live tomorrow. And that means you have a whole raft of sustainability challenges to focus on. And I think because of that approach, we also have less backlash here in Asia than I see at the moment in Europe and in the US. I was just at a secret meeting, 25 banks or so, in Switzerland last week, and it's amazing. They're mainly focused on not getting sued by the US attorney and really want to keep the head down. While in Asia, we're focused on getting the job done. Let's just talk honestly about the challenges and let's move on. So it's a long prelude that we're making progress. The train left the station. Yes, there are challenges, but I think in Asia, still a very constructive background. Now, let me highlight 2 financial instruments that I think we have to get better at. So you actually asked me which have been successful, and there are also a whole raft of sustainability finance products that are successful. But let me highlight 2 where we need to get better at. Because in my humble view, for most of the stuff we need to do, we don't have a lack of capital. I really genuinely don't believe that. But we have an issue, first and foremost, with the risk-return profile of many. You very rarely correctly mentioned, for example, credit ratings of countries. Which US pension fund would fund a renewable energy project in Laos? I don't know a single one. And that's simply because it's not investment grade. So one product that we have known for years and years, and every banker would know this for years, is blended finance. We know exactly how to do it, but we have utterly failed to scale it. And recently in Singapore, together with the government, we set up a new platform which we call FAST-P, Financing Asia's Transition Partnership. And the government put money on the table, and the idea is to catalyze up to $5 billion into 3 different platforms. They focus on different things. And we just actually going to launch the first fund out of this. And the whole idea is that whilst the assets we're financing are all very bespoke, they're all very unique, the financing instrument that you offer to investors can actually be standardized to some extent. And we hope to generate a lot of flow. And this blended finance is, in layman's terms, just you take private capital and commercial capital and public money, you blend it together ultimately to reduce the average cost of capital. You just need to identify which provider of capital has what risk return ultimately that they want to meet, and then you blend this all together. It's a very simple concept, but we need to get much, much better at that. And we were joking a little bit before we came on stage. I think blended finance has a second advantage. If you are the president of France, the UK, or Germany, it's very difficult to go to your electorate and say, hey guys, we're going to write a check now for 10 billion for India. The voters in France, in England, and in Germany, they might not like this. But if you use blended finance, actually it's a very intelligent instrument where you can channel public money into development banks and ultimately into the global south. So I think it's one area. And the other one is carbon markets. It's also a product that we have known for years, has been challenged quite a lot. There was an erosion of trust for many reasons. Do these carbon projects actually deliver on its promise? Do they deliver the carbon removal or avoidance that they promised to do? We were a little bit in a state of crisis in carbon markets. And we have slowly addressed some of these issues that created a lack of trust. But it's an amazingly intelligent financial instrument that allows to match those in need of capital for certain climate mitigation actions, and those that have capital, you can channel it straight into the end consumer, so to say. You don't have to channel it via government budgets, but it always gets very complicated. And I think here in India, seemingly very interesting developments in the carbon market. So blended finance and carbon markets, in my humble view, is something that we really have to scale. Final sentence, we are working on a new form of carbon credits that have never existed. We call them transition credits. We are a global coalition of governments, regulators, think tanks, and so on. And this is all about financing the early and managed phase out of thermal coal power plants and replacing them with renewable energy. And we want to create a new sliver of capital, which we call transition credits. We currently work on some pilot deals in the Philippines on that. And we believe this is really a very powerful way of crowding in capital also away from governments.
Excellent, outstanding. I do have follow-up question, but perhaps I can come to it after I cover all the panelists. So, Mr. Sen, you're the co-founder of the Alliance for Removal of Carbon in India.
Yeah.
Can you first perhaps just introduce your organization and tell us how exactly, when did you found it, what is the purpose, and how are you going about achieving your objectives? What are your main objectives?
Yeah, thank you, Rajiv, and thanks CII for involving all of us, and particularly including removal, which is a relatively new topic. So, and great that my fellow speaker touched upon carbon markets as a finance tool, which I'll also wanted to talk a little bit about. So, otherwise, I'm going to talk about something pretty new, which is as new as 2018 globally. And let me just, first of all explain what we do, but also give the concept of carbon removal and its role in this whole green transition journey. So CRIA, which is Carbon Removal India Alliance, is essentially a member organization or a trade coalition of a few startups. Since it is a new industry, this is startup driven, not large corporates have entered this, which are essentially project developers who are leveraging carbon market, but to do something which is different from what we have been talking about mainly, because most of the green transition discussion has been about mitigation, adaptation, and decarbonization. Whereas since 2018, IPCC has been championing the case for permanent greenhouse gas, particularly carbon dioxide removal. Now, what does it mean? We know about decarbonization, which is either avoiding or reducing emissions in the atmosphere. But the theory of removal is that there has been a lot of accumulated CO2 and greenhouse gases over centuries, even before we started the decarbonization journey. That is point number one. Point number two is certain industrial activities are difficult to decarbonize. We all know that. Shipping, aviation, cement, power are very difficult to decarbonize. So IPCC says that if you have to achieve the Paris targets of 1.5 degree or now 2 degrees or whatever, you have to also, parallel to decarbonization, you also have to remove what is already accumulated in the atmosphere, and permanently, this word permanency and additionality are very important here, store either in the ground or in the ocean. And this is essential to achieve the target, as I said. And IPCC sets the targets of 10 gigaton per year till 2050 to, again, achieve the Paris targets. So since we are in a room of CSOs and corporate executives, we perhaps have heard about CCUS, which is carbon capture, utilization, and storage, which is used. First and foremost, CCUS and CDR are two different things. Why? Because in CCUS, somebody is emitting, let's say, 1 ton of carbon dioxide. I'm just capturing it, storing it, or using it. So it is, net effect is zero. But it is not addressing what is already there, right, over centuries. So that's the role of removal, and that's its role for achieving net zero. And there are temporary removal and permanent removal. We all know that a big part of Indian voluntary carbon market, and India, by the way, has the largest voluntary carbon market in the world, has been in forestry and agroforestry and basically planting trees, which is obviously one easiest ways of capturing CO2 through the photosynthesis process. But the tree can die or catch fire or can be cut for whatever use. So it's not permanent. Typical duration could be 100 years, 200 years. Whereas again, IPCC's definition of permanence is 1,000 plus years. And here comes certain tech-based or novel or industrial solutions of carbon removal. And India can become a leader of some of these technologies. All the ingredients are there. And let me touch upon, out of the 4 or 5 methods, 2 of them, which are very critical in the Indian context. One is called biochar carbon removal. I don't know how many of you or anybody from agriculture industry. So biomass, if it is pyrolyzed, which is burnt at a high temperature, low oxygen environment, it becomes charcoal with a high carbon content called biochar, which is then, it should not, I mean, it can be also applied in furnace as a co-firing for fossil fuel, but that's not removal, that's avoidance. You have to use the biochar either in agriculture field and thereby sequestering the carbon permanently in the soil. And there is a new use which can be relevant for construction industry. It can also be, sequestered in ready-made concrete or, basically cement, and thereby permanently storing the carbon. And the biggest point here is that there are at least 4 or 5 co-benefits in addition to achieving net zero. This method is improving the soil organic carbon, which is depleted in Indian soil. It is managing the acidity because biochar and the other one, which I'm going to talk about, are acidic materials. So it's managing the pH factor. It is increasing porosity. It is helping water to be retained, fertilizer to be retained. So essentially, it is improving agriculture yield in a very sustainable manner. It can help in abatement of air pollution because biomass, if it is burnt openly, we all know in Delhi what happens. It's going to happen soon, air pollution. I'm part of the CII's CEO Forum for Clean Air, which is why I'm here. So we're working on a lot of mechanisms of what we call CRM, crop residue management. And biochar could be one of them, and thereby helping air pollution, agriculture I talked about. Lastly, lots of jobs can be created because India has lots of biomass and lots of agricultural land where it has to be applied. It can reduce fertilizer subsidy and dependence on imported fertilizer, which incidentally overuse of it is not good. So there are so many economic and environmental advantages of this methodology that, and India has a big potential of doing it. There is another method which is equally interesting, one step behind biochar in terms of technology readiness, called enhanced rock weathering, which is related to the mining industry. So any silica rocks react naturally with atmospheric H2 and CO2, and over a period of 100 years, slowly converts the CO2 into carbonate and bicarbonate, which then flows with water rainfall and goes to the ocean. And this is even more permanent than biochar, 10,000 plus years of permanence. Now, if you use the waste of, silica rocks, silica rocks are used in construction industry, railways and all that. So what is less than 2 micron is actually a waste of the mining industry. It's of no use in construction. So that rock dust can be actually sprayed and applied on agriculture field. And what was happening earlier in 100 years will get enhanced. That's why I call enhanced rock weathering. And it's simple common sense because the surface area is increasing, right? And this process can happen in 4 years' time, and carbon gets sequestered, and a lot of minerals can get added to the soil, and the similar advantages of biochar can happen on the soil. So essentially, this is what removal is about. And Article 6.4 after COP29 has created a pathway for removal to be used in international Paris Agreement-related structures. SBTi has come out with a removal standard this year in their version 2, and they are only talking about scope 1 emission under removal for scope 1 emission. The other last point I will make is that insetting is also a very complementary tool. We all know about offsetting. Somebody makes emission, and to compensate that you buy from somebody else who's actually removing or reducing carbon dioxide. That's offset market. But if you do it in this process in your own supply chain, for example, an agriculture company, let's say like ITC, which has a long agriculture supply chain, if they reduce emission in their scope 3 supply chain, which is agriculture value chain, that is called insetting. They're financing that whole thing, which not only is helping them achieve their net zero standards, but also has direct benefits of yield improvement and sustainable agriculture and so on and so forth, which is a direct commercial benefit for them. So there are various tools, offset market, voluntary market, compliance market, insetting, which can support this. But there is a big, important strategic case. And Rajiv, I will perhaps stop here, but if people are interested, we can talk a little bit about what's happening in the carbon market in Indian context.
Sure. So just one quick follow-up, Asitava, if I may. this is not the carbon removal market is not a compliance market. Obviously, it does not have a published price, so to speak, dollars or euros per ton of carbon removed. If I am an young Indian, I wish young, that is, entrepreneur and had a great idea, business idea for a carbon removal sort of enterprise, how do I go about preparing the financial, how do I forecast, how do I figure out whether it makes financial sense or not?
Yeah, you're right.
Perhaps quickly.
Very quickly. So currently, 100% of the removal market is through VCM, voluntary carbon market. And not so happily, it's 100% exported. Not a single Indian company is buying removal credit yet. Maybe part of the reason could be lack of awareness, but I think the main reason is removal credits are much, much more expensive than cook stove or forestry or renewable energy. A biochar credit is an average $150 per ton. Rock weathering is $250 per ton. So it's a handful of international companies which are also surprisingly not emitters. It's all the IT companies and service companies which has very high profitability ratio. Microsoft, Google, Stripe, McKinsey, BCG, JP Morgan, some of these are top names. They are buying this credit in the voluntary market.
And are they, do they typically buy in advance, so to speak,
yes.
Before making the investment? I can sort of sign an agreement?
Absolutely. So there are cases, Google has given a 10-year, 100,000 ton biochar purchase agreement to a company called Varaha in India, for example, as an example. So typically this is used as financing the project. And just wanted to make a last point. So this part is clear. What is difficult today is monetizing the co-benefit. I talked about all those co-benefits. So technically, biochar should be a sustainable agriculture input, like soil conditioner or soil amendment products, and there are various products in the market: biopesticide, biostimulant, biofertilizer, and so on and so forth. But because it's a new industry and there is no endorsement or scientific government-sponsored scientific experiment, which actually derives at some kind of mode of action for how much biochar to be put in what crop at what time and so on and so forth, which is most optimal. It is difficult for the project developer to monetize this co-benefit. Once that happens, biochar can be sold at a price to the farmer. There will be a demand that can reduce the carbon credit price. That will hopefully help and motivate and nudge the Infosys and TCS and other people to create a portfolio. It is not removal versus decarbonization. It is a portfolio of decarbonization and removal. That's the...
Thanks. Thank you very much. I am looking at my watch, and it's an unusual panel with two Germans in India, German,
One
Austrian.
Austrian, please.
Yeah. Same difference. Who you guys are known for your stickler for being on time, and we are known for, shall we say, flexibility on time. So I don't want you to badmouth my country and culture. So I am looking at the watch and try and finish quickly. But Helge, just one other point before maybe I'll ask everyone for your final one change. But I just wonder, as a financial institution, how does your credit committee look at sustainability together with the business risk? I mean, is one a gate which has to cross before a business risk will be considered, or is it a sort of a comprehensive score? Is it a sufficient but not necessary concept that applies to one or the other? How do the two sets of risks looked at by the bank before making a credit decision?
Integration is the key word. So it's fully integrated. So sustainability is not the icing on the cake, it's the cake itself. So if you want to lend money to a company, then there's one seamless process in one seamless system where at some point of time it says you need to do a sustainability assessment. Depending on the type of loan, depending on the sector and so on, you need to fill in a fairly comprehensive ESG questionnaire, which in the meantime, in our case, GenAI is doing for you. So you literally just have to upload data. And then it's filled in, which the relationship managers love. But it's fully integrated. So you then trigger an ESG, borrower-level ESG score, which triggers a mutually exclusive decision tree. So if there's no risk, you move on to the next stage of the process and grant the money. If the risk is high or very high, you need to do certain other things. So integration is the critical piece. It all comes together. So the way we look at climate risk, it's not a risk category, it's a driver of credit risk or reputation risk. So it's really fully integrated into the thinking.
Thanks. Looking at the time, can I just end with one question for all the panelists, starting with you, Madeline. If there is one change that you want to see in this area, which would make financing more readily available to the Global South, what would it be, looking at your sector?
Yeah, no, great question. And I think there I have to highlight again that harmonization is key. So that really standardized methodologies and frameworks are required to enhance comparability and accountability, and partially that's still lacking. So that's we really also at PCAF strive for this harmonization, as I elaborated before. But maybe also here in the Indian context, I can highlight that we, for instance, also on regional collaboration work a lot. For instance, currently developing collaboration also with CII. So to really also see that in the different markets where we're operating, that we are strongly aligned with the existing frameworks and not adding additional burden to financial institutions, but actually really give clear guidance how to, move forward and how to ensure a smooth and, as Helge said, integrated approaches also, and speed up the climate action that is needed.
Thanks very much. Mr. Chatterjee, hard to abate sector, so I don't know what one change can really unlock, but perhaps if you look at your business in this part of the world, in the Global South, so to speak, what is the one change you'd like to see, either from the government or anyone else, that could help on the journey towards transition in your sector?
So this is a sector which is growing in the Global South, especially in India. We need, just to give you a reference, 1 million ton of new capacity requires $1 billion. And India is looking at a demand which will be delta to where we are of another 150 million. Today we are 150, we are targeting about 300 million demand with the phase of growth that India is in. So we're talking about funding to the extent of about 150, $175 billion in the next 5-6 years, only in this sector. So today the transition financing or decarb financing economics versus corporate economics there's not much of a difference, 20-30 basis point maximum, okay? And that the elaboration of getting that funding is so painful that often most companies do it on their own. So I think that's, I think the availability of capital on terms which makes the investment more investable is something which is important. Secondly, I think from a government policy point of view, I think we need to have the ability to have more of structured finance to make the last mile closure on the project financing. And finally, I think the bank's risk-reward ratio is too skewed at this point of time for investment in hard-to-abate sectors.
Thanks. I think we have seen some common threads actually. You used integration, harmonization, blended finance, and perhaps Mr. Chatterjee was also hinting towards that. But Asitava, we didn't even start talking about the CCTS, which I suspect will be the one change you'll want to see. But perhaps if you could expand on that.
Yeah, there is a new Indian compliance market called Carbon Credit Trading Scheme, which all of you are aware of, 8 obligated entities, primarily compliance market, primary focus is energy efficiency, approved, I think 8 methodologies of action has been approved. And then there is a small offset market to create liquidity. None of this has been officially launched, expected anytime, hopefully, last quarter of this year or early next year, running a bit late. But this is a good step. And for me personally, I mean, for Kriya, biochar is included in the offset approved list, which is the first CDR method which is approved, which is a good, I would say, signal to the corporate sector. And while methodologies are developed, we advocate alignment with global standards. In our case, for removal, there are removal specific standards by Puro, by Isometric and some of those companies, and even for the product, there are international biochar specifications and things like that. So no need for reinventing the wheel. And thirdly, we believe that export should be freely allowed because it is going to take time and it's also going to help Indian corporate purchases. So it should not be one versus the other because there is an issue of where the credit goes, whose NDC it goes, and there is a concept of corresponding adjustment and so on and so forth. So this is CCTS, and parallelly, India and Japan has signed the first Article 6.2 agreement called Joint Crediting Mechanism last month only. It's a great beginning, I would say. The National Designated Authority, which runs Article 6, has last month been expanded from 10 members to 21 members. So new ministries like steel, aluminium, shipping, petroleum have been included, which indicates that India wants to expand the approved list of activities, which was published last year under Article 6, which talks about CCUS among various other things, which requires a lot of risk capital and heavy investment like green hydrogen and battery storage and things like that. I mean, Niti Aayog is taking note of removal and other novel methods. So I think there is a lot of tailwind I see, and I would like to see removal being part of the mainstream discussion in corporate, in government, India having a removal strategy which is complementary to its decarbonization strategy. And particularly these two methods, because of its co-benefit, should be taken up in mission mode. So much not for removal per se, but for all the other co-benefits, significant economic and environmental co-benefits that I just talked about.
Thanks very much. Helge, final point. What change would you like to see which will enable you to write a check of $2 billion payable to Apraava Energy before you leave Mumbai later on? My office is right opposite the terminal 2.
Firstly, one comment, and I just wanted to highlight that as well. For us as a bank, what we're really, really keen on doing is transition finance. Green finance, financing green stuff, to us is BAU. And the vast amount of our economy is not green, probably 95+%. If we just focus on financing green, we're never going to get anywhere. We actually have an entire transition finance framework where we really want to help our clients move away from polluting activities, and we don't care whether our finance emissions go up and down. That's beside the point. We want to help our customers. So transition finance is really critical. The one change, if I look at a country like India, and that's more broadly true for Asia, we have everything that it takes. We have innovation power. All the bright ideas are there. We have manufacturing power. So we have scale. So what we now just need to do, in my humble view, is talk with each other and create an ecosystem. We've just done this in a regional initiative where we got the entire real estate sector into the room. Real estate companies, their regulators, financial institutions, our regulators, and policymakers. And we asked the real economy, what's holding you back from transition? And it was really exciting to see how then everybody in the room understood, okay, that's actually my job, and you can't do this, and so on and so forth. And that is insanely powerful. I know it sounds simplistic, but that is what we really have to do because we're all accountable, all of us own this, but nobody can do it alone. The private sector has a role to play, we have a role to play, and getting everyone into a room and building this because we need policy certainty, we need to know the direction of travel, and so on and so forth. It would be one, not change, but we need to get even better at bringing it all together.
On that positive note, thank you very much. Thanks to all my co-panelists. I would have loved to go on a bit longer, but wanted to finish on time. Thank you very much.
Thank you very much.
Thank you. Thank you to our panelists for such an insightful and engaging dialogue on this critical role of climate finance. Now may I please request all the speakers to step forward for a group photograph. Thank you. Now, I kindly request our moderator, Mr. Rajiv Ranjan sir, to present the token of gratitude to our speakers, please. I kindly request Shikhar sir as well to please hand over the Gratinov token to our moderator, please. Thank you, everyone. Now, I request all of you to join us. Yeah. Now, I request all of you to join us for the session on turning barriers into bridges for a climate-ready global south in Sovereign Hall. So it's just the hall nearby. And before I leave, a humble request to ensure to everyone to explore our inspiring step wall, which is installed outside, which is beautifully showcasing the CII-CSD's 20 years of journey and key milestones. And please visit the exhibition on sustainability solutions beside the Inspire Hall staircase. And apart from that, do not forget to snap your photos with Dhara, the CII sustainability mascot, to share the memories online, and do not forget to tag us as well and with the community. With that, thank you so much for your time.